Have you ever considered an investment fund that isn't just about, the bottom line, the financial returns, but one that's also really carefully designed, meticulously put together to align with specific ethical or even religious principles? And get this, what if that fund wasn't just sort of compliant with those values, but was actually, well, outperforming the broader market, making some pretty significant waves? Well, today on the deep dive, that's exactly what we're going to try and unravel. Our spotlight is firmly on SPUS. It's a fascinating Sharia-compliant exchange-traded fund, an ETF. We're really doing a deep dive today into a recent, pretty expert analysis of its performance, which has been quite remarkable, and what its future might hold.
That's absolutely right. And we're not just looking at, another stock or another ETF today. We're exploring something quite unique here, an investment vehicle that really, at its core, brilliantly marries rigorous financial strategy with a very distinct, powerful set of values. And it's a blend that's proving to be, well, incredibly successful. It really challenges some of those conventional ideas about investing, doesn't it?
Yeah, it really does. So our mission today is to properly unpack the core features of SPUS. We need to understand its recent market performance, which, as you said, is quite impressive, and then really dig into the analytical methods that JinLog, the expert behind our main source today, used to assess its potential going forward. We'll explore what makes it tick, how it stacks up against broader trends like the S&P 500, and also what's the chatter? What's the wider investment community saying about it, especially those interested in ethical finance?
Exactly. And it's important, I think, to acknowledge right up front, our main source for this deep dive is this detailed commentary from top trader JinLog. Now, this report uses a very specific, quite advanced methodology called VPAR, rhythm analysis. We've really gone through this report, pulled out the most important bits of knowledge, tried to distill some of the complex technical stuff. And we're here to bring those key insights straight to you, making sense of what is, admittedly, a highly technical analysis.
So, why does all this matter to you, the listener? Well, whether you're an investor actively looking for diversified strategies, maybe exploring alternatives to the usual stuff, or perhaps you're someone genuinely interested in this whole growing field of ethical finance, which is really evolving fast, or maybe you're just, curious about unique market niches that are doing well. This deep dive offers a real shortcut to understanding a pretty significant and, I think, increasingly influential segment of the investment world. We promise some genuinely surprising facts, some insights that will absolutely broaden your perspective on what actually defines an investment in today's complex financial world. So let's start by peeling back the layers. Decoding SPUS. What is a Sharia-compliant ETF? Okay, let's unpack this, starting right at the basics, because I think even the term Sharia-compliant ETF might be new for some listeners. What exactly is SPUS? And more importantly, what makes it so unique in this huge universe of ETFs out there?
Right. So at its core, SPUS is an exchange-traded fund. It currently invests in, I think it's around 218 companies. Yeah, 218. And these are all drawn from the S&P 500 index, which most people know. But here's the crucial bit, the real differentiator, and it's really the defining feature of this fund. These companies aren't just any S&P 500 stocks. They are very specifically chosen because they strictly adhere to the principles of Islamic Sharia law. And this compliance, it's not just a footnote or a light filter, it's fundamental. It guides the fund's entire investment strategy, shaping every single decision about what goes in.
Okay, so Sharia law isn't just a sort of vague ethical guideline then. It involves really specific criteria, specific prohibitions that dictate investment choices. Could you elaborate a bit on what these principles actually mean for, making investment decisions? What kinds of companies or practices are definitely off limits? How does that narrow things down for SPUS?
That's a really vital distinction, yes. It's much more concrete than many general ethical screens you might see, like ESG, for instance. Sharia compliance in investing involves several very clear prohibitions and requirements. These govern the types of businesses and, importantly, the financial structures allowed. So firstly, there's a strong emphasis on avoiding companies with high leverage, high debt, basically. So a low leverage requirement is critical. This often means excluding many traditional financial institutions, banks, insurance companies, or other highly indebted corporations. Secondly, and perhaps most fundamentally, any involvement in interest-based finance, which is known as riba in Islamic terminology, is strictly prohibited. This means the fund cannot invest in companies whose main business model revolves around earning or paying interest. That's why you just won't find traditional banks or lending institutions in the SPUS portfolio. It's a hard screen.
Right, no traditional banks.
And beyond those financial structure rules, and perhaps more widely known, Sharia law explicitly excludes investment in sectors tied to activities considered unethical or harmful from an Islamic perspective. So that means no involvement with companies whose main business is in areas like tobacco, alcohol, gambling, even conventional defense contractors, whose products might be seen primarily as tools of aggression, are often excluded. It's a really comprehensive screening process. It goes far beyond typical ESG, environmental, social governance criteria. It creates a very distinct, very purposeful investment universe.
Okay, so if you're systematically excluding these entire, often huge sectors like traditional banking, highly leveraged industries, maybe defense, what does that actually do to the composition of the SPUS ETF? How does that exclusion fundamentally shape the portfolio? What kind of companies are, left?
Yeah, this is a really critical point, and it directly influences SPUS's market behavior, its performance, everything.
Yeah.
By applying these rigorous Sharia-compliant filters, the fund naturally ends up creating a portfolio that's often quite heavily tilted towards certain sectors. Think technology, consumer staples, and healthcare. Just think about it. Many of the big tech companies, for instance, they tend to operate with relatively lower debt compared to, say, heavy industry. Their primary business models don't revolve around interest in the prohibited sense. And they typically aren't directly involved in those sin industries like alcohol or gambling. Similarly, many consumer staples firms or healthcare companies, they can more readily meet these Sharia criteria. So this inherent tilt towards these often growth-oriented and sometimes more stable sectors, especially compared to, say, traditional finance or highly cyclical industries like materials. That's a key characteristic of SPUS, and it largely explains some of its, frankly, remarkable recent market trends.
That's fascinating. The source we looked at mentions SPUS serving as an ethical hedge against uncertainty. How does an ethically filtered fund, just by its nature, potentially function like that, especially during times of, broader market jitters? It sounds like more than just feeling good about your investments.
It's an intriguing idea, isn't it? And I think it speaks to both financial and psychological stability. By deliberately avoiding certain industries that are often seen as more volatile, or perhaps those that face significant ethical backlash during market downturns.
Yeah.
Think about past scandals in banking or controversies around certain defense contracts. Some investors genuinely view SPS and funds like it as a potentially more stable or values-aligned investment. During periods of economic stress or geopolitical uncertainty, investors might, maybe subconsciously, gravitate towards assets that feel like they represent a degree of moral or societal soundness.
They might perceive these companies as more resilient, precisely because their business models are inherently less exposed to certain systemic risks, or perhaps less vulnerable to public backlash. So it's not just about the potential for financial stability, though that's part of it. It's also about aligning your financial decisions with a deeper set of personal or community values. And that alignment can provide a sense of psychological stability, that kind of confidence in itself, almost regardless of the day-to-day market swings.
Right. So if you're an investor who really puts a premium on social responsibility, or you adhere to very specific ethical or religious guidelines in your financial life, this fund immediately jumps out as a really compelling option, doesn't it? It's not just about the potential for returns, but about how those returns are generated. It offers that peace of mind alongside the potential for financial growth.
Right.
2, SPUS's market performance, outperforming expectations. Okay, now let's get to the numbers, because this is where the story of SPUS gets, well, even more exciting. The report highlights some genuinely impressive returns. What are we actually looking at in terms of direct comparisons to the S&P 500? That's the usual benchmark, right?
Yeah, the numbers certainly speak for themselves. They show clear, significant outperformance. Get this, SPUS has achieved a year-to-date gain of 8.25%.
Wow.
And to put that in context, it notably outpaces the S&P 500's gain, which was 7.06% over the same period. And if you stretch that out, look at the one-year return, SPUS boasts a really robust 19.06%.
19%.
Yeah, which again substantially beats the broader index. And look, this isn't just a tiny difference, a marginal beat. It represents meaningful, consistent outperformance over both the short term and the medium term, which is quite remarkable, really, for a fund that operates with such specific and what some might think are restrictive compliance criteria. It clearly shows that sticking to these principles hasn't held it back. In fact, in this case, it seems to have actually enhanced its market performance.
Okay, here's where it gets really captivating for me. The report states that SPUS has held this steady upward box range for nearly 3 months, and it's been mirroring major tech-heavy indices like the NDX, that's the NASDAQ 100, and even really aggressive leveraged tech ETFs like TQQQ. Now, how on earth can a Sharia-compliant fund be so closely tied to the recent incredibly powerful tech rally? That seems, just on the surface, almost counterintuitive.
Yeah, it does seem odd at first glance, but this connection is absolutely crucial and circles right back to what we were just discussing about the fund's inherent composition. While SPUS meticulously kicks out certain sin sectors and companies deep in interest-based finance, its Sharia-compliant screening process naturally, almost automatically, leads it to have significant exposure to the technology sector.
Right, the leftovers, so to speak.
Exactly. Think about it. Many leading tech giants have relatively low leverage, their main business isn't traditional interest, and they generally don't have direct ties to prohibited stuff like alcohol or gambling. So as the whole technology market has had this powerful, sustained rally driven by innovation, digital transformation, and now, of course, the huge buzz around AI, this rising tide in tech has inherently lifted SPUS right along with it. It's a really compelling demonstration, I think, that ethical investing doesn't automatically mean sacrificing growth. In this specific case, it's actually positioned the fund perfectly to benefit hugely from a major market-leading trend. It's created this unexpected synergy between ethical filtering and high performance.
And the report also looks ahead. It mentions a technical concept, something called the Trap 33 relief wave. And it suggests that a major rally could unfold next year.
Okay, what exactly does this highly technical term actually imply for SPUS's future? What are these analysts seeing in the charts, in the data, that suggests such a strong upward move might be coming?
Right, this definitely takes us into the weeds of advanced technical analysis. This is the kind of stuff frequently used by experienced traders and analysts like JinLog. Think of the Trap 33 relief wave as being like a market-coiled spring ready to release. It's a specific pattern they identify within certain analytical frameworks like Elliott wave, which we'll touch on later, and it typically indicates a strong reversal coming off a corrective phase or a consolidation period.
Okay.
Essentially, it suggests that the selling pressure, the downward force, has pretty much run its course. It's exhausted, and the market is now poised for a significant upward move. It's designed to, well, trap, hence the name, or mislead traders who might be betting on a continued decline. They get caught short.
Ah, I see. And then the market surges upward instead. It implies that the underlying momentum for SPUS is building. It could signal the end of a period of going sideways or having minor pullbacks, and the start of a powerful new upward trend, the very bullish signal for a sustained rally. Possibly because the consolidation phase is reaching its definitive end, setting the stage for what JinLog anticipates could be a major rally next year. 3. The VPAR rhythm trading method. Deconstructing the analysis.
Okay, so these powerful insights we're talking about, especially those forward-looking predictions for SPUS, they come from JinLog's report, which, as we mentioned, uses this VPR rhythm analysis methodology. Now, for those of us who aren't, steeped in the world of advanced trading algorithms and complex charting, what exactly is VPR, and why is this methodology highlighted as being so significant in this analysis? What makes it stand out?
Right, VPAR. It's a specific and, frankly, highly sophisticated analytical framework. It's designed to pinpoint optimal trading opportunities. Its fundamental philosophy is quite layered, actually. First, it tries to capture the overall market timing, understanding the bigger picture, the broad currents, the dominant trends across the entire market. Only then does it zero in, with precision, on key news events and significant market shifts at what it calls MAC points.
MAC points.
Yeah, think of these MAC points as critical junctions on a price chart. They're essentially major support and resistance levels. Support is like that invisible floor where prices tend to bounce back up, and resistance is like an invisible ceiling they struggle to break through.
Got it.
Now, the VPA methodology marries insights from observing chart rhythms. That's how price patterns unfold over time, like the ebb and flow of a tide with detailed funds flow patterns. Funds flow is basically tracking where the money is actually moving. Is it flowing into an asset or out of it? This dual approach gives it a really comprehensive dynamic view. And to elaborate a bit, VPA uses what it calls a blending analysis approach. This means it doesn't just look at one isolated data point or, a single indicator in a vacuum. Instead, it combines granular sector analysis and individual stock analysis with real-time, live monitoring of the major indexes. Imagine like conducting a symphony of data points. Different instruments, sector performance, individual stock moves, broad market trends, all playing together.
Okay, interesting analogy.
This integrated approach is specifically designed to help manage risk, while at the same time aiming for higher returns by precisely timing market entries and exits. It's really about understanding the complex interplay of all these various market forces. It's almost like trying to decipher the market's own unique heartbeat or rhythm.
So it's not just looking at one single straightforward metric, but it's more like a complex, almost symphonic understanding of data points across multiple layers of the market.
That sounds incredibly intricate, like trying to predict the weather based on wind, temperature, atmospheric pressure, all interacting at once.
Precisely. Your weather analogy is actually excellent. That's a great way to think about it. It's about discerning those often hidden underlying market currents, and then predicting, hopefully with a high degree of precision, how those currents will interact with specific assets like SPUS at those critical points, those MAC points. It definitely goes far beyond just looking at a stock's past price moves or a few basic technical indicators. It seeks to understand the very rhythm of the market, how investor capital is flowing through it, and that provides a much deeper predictive capability, potentially, than many more conventional methods might offer. Yeah, even if you're not a professional trader who's going to go out and implement VPR yourself,
Yeah.
just understanding the lens, the framework through which this expert views SPUS, it really helps you, the listener, appreciate the incredible depth of the analysis involved. And it also helps make sense of the specific, almost specialized vocabulary they use to describe these complex market movements. It really is like a peek behind the curtain, isn't it? Seeing how some financial pros make sense of incredibly complex, fast-moving market data and then try to turn it into actionable insights.
Definitely. It shows there's a whole world of signals beneath the surface for those who know how to look. 4E, financial flow and investor confidence, the underpinnings of growth.
Okay, let's shift gears a bit now and talk about the actual money flowing into SPS, because that tells a really significant story about investor confidence, about the fund's underlying health. The report states its assets under management, or AUM, is around $1.51 billion. Now, that makes it one of the largest Sharia ETFs out there. What does that substantial figure tell us about its standing in the market?
Yeah, an AUM of $1.51 billion is definitely a significant figure for any ETF, but especially for one operating within what is still considered a niche, albeit, as we've said, a rapidly growing niche, like Sharia-compliant finance. This substantial AUM indicates strong and broad investor confidence. It's a big number. It means a considerable amount of capital has already been entrusted to this fund by investors. That's a powerful endorsement from the market, reflecting trust in its strategy and its compliance. And furthermore, a large AUM generally provides better liquidity for the fund,
Okay.
which means it's usually easier for you, as an investor, to buy and sell shares without massively impacting the fund's price. It ensures smoother transactions, less potential price slippage for bigger orders. It implies stability and efficient market operation.
And what's maybe even more telling than the total AUM is the net inflows figure. The report says a remarkable $688 million flowed in over the past year alone. What does this consistent influx of capital signify for SPUS's path, and maybe for the broader demand for this type of investment?
Right. Strong net inflows, especially sustained over a period like a year, are a really powerful demonstration of active and, importantly, growing investor interest. It signals that fresh money is consistently entering the fund. It's not just existing money churning around or being offset by people selling out. This influx of fresh capital often provides a crucial tailwind for performance. The fund managers can strategically deploy that new money into investments, potentially expanding the fund's reach or reinforcing strong positions. But more importantly, I think, it reflects a clear and growing appetite in the market for Sharia-compliant investment options. It indicates that a significant segment of investors is actively seeking out and allocating capital to vehicles like SPUS. It's a strong vote of confidence from investors looking for both that ethical alignment and robust financial growth.
The report also highlights a surprisingly lean expense ratio, 0.45%. Now, for you, the listener, maybe considering an investment like this, why is a low expense ratio so important? How does it actually impact your returns over time?
Yeah, expense ratios directly impact your bottom line, your long-term returns. They represent the annual fees charged, calculated as a percentage of your total investment in the fund. So, simply put, a lower ratio means a smaller slice of your investment gets eaten away by these fees year after year. This allows more of your capital to stay invested and, crucially, to compound over time.
Right, the compounding effect.
Exactly. Think of it like a persistent drag on performance. Even a seemingly small difference in fees can add up to significant savings and much higher returns over decades. For investors, especially those holding for the long term, or maybe those pursuing a more defensive growth strategy, a low expense ratio, like 0.45%, makes SPUS considerably more attractive. It signifies cost efficiency, and that translates directly into better net returns for you over the life of your investment. It literally puts more money back in your pocket.
And it also offers a recent dividend payout, and NHRs are 3 cents per share. Now, that might seem pretty small on its own, but what does that signify for the fund's health and maybe its attractiveness to certain types of investors?
Yeah, $3 per share might look modest in isolation, absolutely. But it's less about the absolute amount and more about what it represents for the fund's underlying strength. This dividend payout demonstrates that there's a steady cash flow being generated from the actual companies held within the ETF portfolio. It indicates that the companies SPUS invest in are profitable and are distributing some of those profits back to their shareholders, including the ETF itself. For investors, particularly those who value some consistent income stream alongside the potential for capital appreciation, this is another positive indicator. It shows the fund isn't just purely focused on growth at all costs. It also provides a regular, albeit maybe small, income stream, which reinforces its appeal as a potentially well-rounded investment vehicle that can cater to different investor needs. Technical deep dive. Rhythm analysis and Elliott wave theory.
Okay, now we get into the really intricate stuff, the rhythm analysis and Elliott wave theory. JinLog's report relies heavily on these for its forward-looking predictions. The report breaks down the rhythm analysis into short-term, swing, and mid-term views. For those of us trying to follow along, what exactly do these different rhythms tell us about how SPUS is behaving in the market across these different timeframes? And why is this multi-layered view so important?
Right, this is really where that VPAR methodology comes into its own, offering this multidimensional view of the market's pulse. It's like analyzing a patient's heartbeat at rest, during exercise, and over a longer period. Let's break down each rhythm as the report sees it, that SPUS. For the short-term rhythm, the analysis says the trend is accelerating and being maintained. The rhythm itself, the immediate pulse, is rising and maintaining. Strong and consistent positive momentum. And crucially, the funds flow is expanding and stable. Fresh money is steadily coming in. So what this tells us is immediate, strong, positive momentum. SPUS is currently on a clear upward path, and increasing investor capital is backing that move. This is often what day traders or very short-term momentum players look for.
Okay, immediate strength.
Then, when we look at the swing rhythm, which considers a slightly longer time frame, maybe weeks to a few months, the trend is still seen as accelerating or maintained. But the rhythm itself is showing some signs of weakening or maybe correcting, a bit of a pause perhaps. However, and this is key, the funds flow is still expanding. Money is still coming in. This suggests that while the broader upward move is still intact, there might be some potential for consolidation, maybe minor pullbacks within that larger trend. But the crucial point is, despite these small dips or pauses, investor interest remains strong, shown by that expanding funds flow. It suggests any dips might be seen as buying opportunities by new investors.
Okay, so potential dips, but still underlying interest.
Exactly. And finally, the midterm rhythm. This looks at the bigger picture over several months, maybe even a year or more. Here, the analysis shows the fund entering a phase of consolidation or formation. The rhythm is forming, and funds flow is still expanding. Now, this is a critical phase for longer-term investors. It suggests SPUS is actively building a base, a foundation, for its next major upward move. The fact that investor capital keeps increasing during this consolidation period is a very positive sign. It indicates the fund is accumulating strength, gathering energy, and preparing for potentially more significant, sustained rally in the future. It's like, as you said earlier, a stock taking a deep breath before its next big climb.
That makes a lot of sense, seeing it broken down like that across different time scales. It really is like looking at the same landscape through different levels of magnification. But the report also dives deep into Elliott wave analysis, using these terms like wave 3, wave 2 corrective phase, trap 23, and trap 33 relief. For those of us less familiar, can you try and demystify this complex theory? What do these specific wave patterns actually mean for SPUS's potential future movements?
Absolutely. Elliott wave theory. Well, it's a pretty comprehensive form of technical analysis. The basic idea is that financial markets move in predictable recurring patterns, or waves. These patterns are thought to be driven by collective investor psychology shifts between optimism and pessimism. Typically, you see 5 motive waves moving with the main trend and 3 corrective waves moving against it. It's all about finding the underlying structure in what can look like chaotic market noise.
Okay, patterns in the chaos.
Exactly. So let's apply that to SPUS, according to JinLog's report. For SPUS's short-term wave, the report says it's currently in wave 3, and it mentions this trap-come-3 relief and rhythm expansion signaling acceleration. Now, wave 3 in Elliott wave terms, is typically the strongest, most powerful, most impulsive part of a trend. It's where prices tend to move rapidly in the direction of the main trend, often seeing the biggest gains. The Trap 23 relief likely refers to a specific little sub-pattern within this wave. It suggests a temporary pause or a minor dip that's designed to trap or fool the bears people betting on a decline, making them think the trend is reversing.
Ah, the trap again.
Right. Only for the strong upward continuation, the main wave 3 force, to kick in immediately after. It basically reinforces the acceleration and catches some traders on the wrong side. Moving to the swing wave, the analysis indicates it's in a wave 2 corrective phase. But, crucially, the expanding funds flow suggests strong rebound potential. Wave 2 is a common pullback after the initial Wave 1 impulse. It corrects some of those initial gains before the next, usually stronger, upward move, which would be Wave 3 on this time frame. However, the fact that funds flow remains strong during this correction is very positive. It means buying interest comes in quickly on dips, limiting how far the correction goes and setting the stage nicely for the next big impulsive move upwards. It signals underlying resilience.
And finally, the midterm wave. This is where the most exciting long-term forecast for SPUS lies in this analysis. The report says it's initiating Wave 3 after completing a Trap 33 relief. This is setting up a powerful impulsive trend. Just like the short-term Wave 3, this implies a significant sustained upward movement, but over a much longer period. And that Trap 33 relief here is considered a very strong bullish signal in this framework. It indicates a powerful breakout from a major significant corrective pattern. It implies that a long period going sideways, or maybe even a decline, is definitively over. It's paving the way for a potentially powerful and sustained rally. And this aligns perfectly with that major rally next year idea mentioned earlier. It suggests all the technical signals across different time frames are pointing towards a significant long-term growth phase for SPS.
Wow. Okay, so for you, the listener, this isn't just a string of complicated jargon, right? This is actually how professional analysts and traders try to anticipate future price movements and devise their, well, pretty sophisticated strategies. It's about seeing these complex patterns, these flows of capital that the casual observer might completely miss. It provides a kind of roadmap for potential future performance.
And to make it even more concrete, the report actually offers specific price targets and support levels derived directly from this analysis. It noted a recent trade point, for example, around $46.42. That level was identified post what it called an algorithmic trend.
Algorithmic trend.
Yeah, basically a trend identified and confirmed by automated trading programs, algorithms that crunch vast amounts of data super fast to spot these patterns. For potential support levels, those price points where the fund is expected to find strong buying interest, where it might bounce at listed $45 for the short term, $44 as a potential swing entry point, and $42.80 for midterm entry. These are key zones where demand is expected to kick in. On the flip side, the target levels, predicted resistance points, or maybe places to consider taking profits include a short-term target of $47 and a swing target of $50. And it also provided those MAC points, the major support levels we talked about, with a swing MAC point of $41 and a midterm MAC point of $39.70. And it even suggested that range trading between these levels is advisable for certain types of active trading strategies. So these are really tangible numbers that active traders could potentially use to inform their entry and exit decisions. It offers a very precise framework for trying to navigate SPUS's market movements, human engagement, and market sentiment.
Now, beyond all the intricate charts and the hard numbers, there's this really vibrant, quite passionate community actively discussing SPUS. The report specifically highlights Reddit's Halal investor community. Apparently, they actively debate SPUS's stability, its suitability for halal investing. What does this community flow, as the report calls it, tell us about the fund's broader appeal and maybe the unique dynamics within this specific niche?
Yeah, this is a truly fascinating sociological angle to SPUS's story, isn't it?
Yeah.
It gives you insights you definitely won't find just by staring at spreadsheets. It clearly shows there's a growing and highly engaged investor base specifically seeking out Sharia-compliant investment options. These aren't just passive investors. They're individuals who are not only looking for financial returns, but are deeply committed to aligning their financial choices with their faith, with their values.
Right.
They're actively collaborating online, sharing information, debating the nuances of specific investments like SPUS. It shows this collective effort to find the best ethical vehicles out there. And the fact that the report mentions 68% of posts within a specific thread, long-term reliability of SPUS on that subreddit, are bullish, that's particularly telling.
Yeah, over 2/3.
Exactly.
Yeah.
This isn't just abstract growing demand. It reflects a rising level of confidence, a positive sentiment bubbling up within this specialized niche. Communities like this often act as powerful feedback loops, shared positive experiences, collective conviction. It can amplify interest and potentially even contribute to a fund's momentum. It highlights how a strong community can really validate and reinforce an investment's appeal, especially when it caters so directly to specific ethical and religious needs. They discuss everything from which companies are included, to dividend reliability, to the whole evolving landscape of Sharia finance. It's really a testament to a market segment that's not just growing, but is deeply engaged and actively informing itself.
And it's not just Reddit, either. The report also notes that on Seeking Alpha, which is another prominent investment platform known for its often quite deep analyses, SPUS is highlighted there as an alternative investment vehicle, and it's often described as being still undervalued. Now, what's the significance of that undervalued perspective, especially after the strong performance we just talked about? Is it just that people don't fully get it yet?
That's a really perceptive question, and yeah, I think you're hitting on something important there. This undervalued view, especially coming alongside its recent outperformance against a major benchmark like the S&P 500, is quite insightful. It suggests that some analysts, some investors, believe SPUS's growth potential isn't yet fully appreciated or maybe fully priced into its current market value by the broader investment community. And that can be down to several factors. Perhaps its niche status just means it's overlooked by some mainstream investors who aren't specifically looking for Sharia-compliant funds. Simple as that. Or maybe its unique compliance criteria, while obviously attractive to its target demographic, cause others to just bypass it without fully understanding its underlying strengths, like that significant exposure to high-growth tech sectors we discussed. Essentially, it highlights its appeal to those investors and analysts who are looking beyond the conventional asset classes. They see potential hidden value in specialized funds that might not be on everyone's radar yet.
Right.
They might perceive SPUS as a kind of diamond in the rough, a high-quality asset that's maybe flying a bit under the radar of the big institutional investors, or those just not familiar with the Sharia finance space. So that undervalued tag, combined with its actual performance and the strong inflows, it really paints a picture of a fund that could have substantial room for continued appreciation as more investors discover its unique blend of ethical alignment and market-leading sector exposure.
So for you, the listener, what this really means is SPUS isn't just some quiet fund humming along unnoticed in the background. It's actively generating buzz. It's driving meaningful conversations across different platforms, online communities. And it's attracting significant attention from a very specific and I think increasingly influential segment of the investment world. It's a fund with a story, a narrative that extends far beyond just its raw performance numbers. It reflects this whole growing movement in values-based investing. 7, outlook and risks. A balanced view. Okay, let's try and bring all these threads together now and summarize the overall outlook for SPUS. The report we've been drawing from neatly encapsulates it, I think. It states that SPUS combines ethical finance, strong tech exposure, and low costs for a stable growth profile. Can you elaborate a bit on why this particular combination, ethics, tech, low cost, is potentially so powerful for investors today? Why is it such a unique value proposition?
Yeah, that statement perfectly captures SPUS's core appeal, its value proposition. And it's a unique blend that, you're right, many investors are increasingly looking for. On one hand, it provides a very clear, very accessible way to engage in ethical finance. It allows individuals to align their investments with deeply held moral or religious principles, consciously avoiding industries they find problematic. And that's not just about doing good. It's also about finding personal peace of mind in your financial life.
On the other hand, as we've explored, its inherent Sharia-compliant screening process naturally leads to that significant and recently very beneficial exposure to the technology sector. Tech has been a huge engine of growth and continues to drive innovation. And critically, it delivers all of this with that lean expense ratio we talked about, keeping costs low for the investor, which, again, directly translates into better net returns over the long haul. So this unique combination means investors don't necessarily have to choose between their values and performance. They don't have to compromise on returns to invest ethically. In SPUS's case, arguably, the ethical criteria have actually positioned it to potentially benefit from strong market performance. It offers this stable, appealing growth profile that could attract a wide range of long-term investors.
But of course, as with any investment, there are always risks involved. It's crucial we understand them before making any decisions, and the report is very clear-eyed about these potential downsides. What are the key considerations, the potential risks, that you, the investor, should definitely be aware of when looking at SPUS, particularly thinking about its concentration and its liquidity?
Absolutely. The report points out two primary risks: and they're crucial for any potential investor to weigh up. First, there's the tech sector concentration. We've talked about how beneficial this has been recently. But it also means the fund's performance is heavily influenced by the health and performance of the technology sector as a whole. If tech stocks were to experience a significant downturn, or maybe just a long period of underperformance, perhaps due to new regulations, shifts in consumer tech trends, or just a broader economic slowdown hitting innovation budgets, SPUS would almost certainly follow suit. Its strength, in this case, is also its potential vulnerability. Diversification within the tech sector itself only protects you so much if the entire sector faces major headwinds.
That makes sense. A double-edged sword.
Exactly.
Yeah.
Second, the report notes its relatively low trading volume compared to, say, giant mainstream ETFs like SPY or QQQ that trade millions upon millions of shares every single day. This lower volume, the report warns, may trigger short-term volatility and liquidity risks.
Okay, can you elaborate a bit on what liquidity risk specifically means for you, the individual investor? Why is that something important to consider, especially if you're maybe not planning to hold for the super long term?
Yeah, absolutely. Liquidity risk, in simple terms, means that if you need to buy or sell a large number of shares quickly, there might not be enough buyers or sellers readily available in the market at the price you want, right when you want them. This can potentially lead to wider bid-ask spreads. That's the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask.
Okay, the gap gets wider.
Exactly. For you, this could mean a couple of things. When you place an order, it might take longer to actually get filled to execute. Or you might have to accept a price that's less favorable than you initially hoped for. Maybe you sell for a bit lower or buy for a bit higher, especially if you're trying to trade a large amount relative to the usual volume. Or if you need to get out fast during a period of market stress. Now, this might not be a major concern if you're making small long-term investments where you're comfortable holding for years and years, but it is an important consideration, particularly for more active traders or even just investors who might need access to their cash unexpectedly. They need that ability to enter and exit positions rapidly at precise prices without moving the market too much themselves. So yeah, it's always wise to understand how easily, how quickly, and at what potential cost you can convert your investment back into cash if you need to. That's liquidity risk.
Wow, what a deep dive that was into SPUS. We've really unpacked how this Sharia-compliant ETF manages to leverage these deeply held ethical principles, not just to comply with its mandate, but to tap into dynamic market trends, surprisingly outperform the S&P 500, and along the way build this strong, actively engaged community of interested investors. It's quite a story.
It really is. We've seen how sophisticated analytical methods like VPAR rhythm trading and Elliott wave analysis are being meticulously applied to try and anticipate its future movement, providing this detailed technical roadmap for potential performance. And importantly, we've also balanced that promising outlook with the crucial considerations, like its heavy concentration in the tech sector and the potential implications of its trading volume and liquidity.
And the report we used, it even alludes to deeper levels of analysis that JinLog apparently explores. Things like detailed screening criteria and industry exclusion impact analysis, really getting into the weeds of how those Sharia filters precisely shape the portfolio. It also mentions delving into growth scenarios based on continued tech rally and AI demand outlook, which is super relevant given SPUS's inherent tech tilt, and even a comparison with global Sharia ETFs and regulatory risk assessment, placing it within that broader global ethical investment landscape.
Yeah, so considering SPUS's remarkable success and this undeniable growing demand for values-based investing that we see across the board, what does this really tell us about the future of specialized, ethically driven funds in the broader market? Could this powerful intersection of ethical finance, rapid technological advancements like AI fueling specific sectors, and maybe an evolving regulatory environment, could it truly be paving the way for a completely new era? An era of diverse, highly focused investment vehicles that really start to challenge those traditional investment paradigms.
It makes you wonder, doesn't it? It really does. We certainly hope this deep dive has given you a fresh perspective today. Perhaps sparked some new questions about how these ethical considerations are shaping financial markets in, well, pretty profound ways. And maybe it's even inspired you to explore the fascinating world of specialized ETFs a little further. Thank you so much for joining us on the deep dive.